Hello, I'm Bernard Hickey from interest.co.nz and welcome to our weekly currencies report. We're here with Dan Bell from HiFX. Welcome back to interest.co.nz, Dan. Another never a dull moment week with it all going off in Greece. We've seen big movements in currencies, worries about financial crisis there. What's the current situation in Greece with the sovereign debt markets and what we're seeing at the moment?
Yeah, so it has been a big week for Greece, so back in focus, and that's being reflected in the currency markets. Quite a lot of volatility this week. Fundamentally, I think we've all known that Greece is basically bankrupt, and we've had politicians and EU and IMF officials in the background trying to put together some type of bailout package. Now, part of the fact that Greece got a bailout last year, they need to pay cash flows on their lending, and effectively they don't have the money. So you've had people talk about Greece defaulting on their debt obligations, which would have devastating implications for the global economy.
So explain to those people who think, well, Greece isn't very big, why should we worry about Greece? How does that translate into problems in the financial markets?
Yeah, so you've had some analysts compare the Greece situation to Lehman Brothers, which was the investment bank that fell over in the height of the global financial crisis in 2008. So the way the world operates now, financial markets are extremely interconnected. So if you've got bondholders, or essentially people that have lent money to Greece, if Greece aren't willing to pay their debts, then those bondholders are going to be taking a loss. Now, those bondholders are mostly European banks. But those European banks took out credit default swaps, which are a form of insurance against the bonds that they sold to the Greek government. So, a lot of the CDS derivative contracts, the credit default swaps, are ultimately owned by US banks.
So there's a US exposure here too.
Absolutely, yeah, absolutely. So the US don't have a significant direct exposure to Greek bonds as such, but they have a significant exposure to the credit default swaps that the European banks have taken out as insurance against the Greek bonds. So if Greece defaults, it's not just the European banks that are going to be hit; it's the US banks as well. And I think markets are extremely concerned about what happens when those credit default swaps go off, because like we saw back in 2008 with the subprime disaster. We just don't know how bad it could get if that really happens.
So the Europeans are trying everything they can to avoid that default moment. As I understand it, the European finance ministers, particularly the Germans, are not keen to bail out again, and they're trying to come up with some sort of voluntary restructuring, whereas the European Central Bank don't want any sort of hint of a default because of the risks to the financial system. That uncertainty on the European front is unnerving people, isn't it?
Very, very much so. So, we've seen weakness in the New Zealand dollar this week, dropping from highs last week around 83 down to just under 80 cents overnight. The euro dollar dropping from up over 145 last week to 140 and a half overnight. So you're seeing the US dollar broadly stronger. The implication, I think, with what the German policymakers want is for some kind of, sharing the risk between the public and the private sector. But ultimately, if there is a default, a technical default, the ECB is saying we can't have that, because the credit rating agencies have already warned them that even if they try to sort of restructure or play with the Greek debt, that it will be a technical default, and there will be implications for those credit default swaps that are sitting out there in the financial universe. And
I'm curious about this. Who decides when there's actually been a default?
That's an interesting question. I don't know. You even had Alan Greenspan, the world's favourite central banker or ex-central banker overnight, saying that in his opinion that Greece was likely to default. So you've got most people are pretty much agreeing that Greece is going to default to some extent, but it hasn't been confirmed yet. So I think ultimately the EU and the IMF and all the officials involved will have to do something. There's a meeting this weekend. There's some type of impasse. has been agreed already in terms of their short-term cash flow requirements, but they're a long way away from getting this issue sorted.
Now, if there is some sort of contagion meltdown in Europe, what does that mean for New Zealand and the New Zealand dollar?
Yeah, so so if we saw a meltdown there, I mean, it's going to have a huge risk aversion. It's going to create a huge risk aversion event. The New Zealand dollar will get sold off heavily against the likes of the US dollar and other safe haven currencies. The interesting thing about the forex markets, the forex market is the most liquid, actively traded market in the world. So if you have a specific event that occurs, investors and traders will use the currency market as a transmission market to unwind positions and put on counter trade, so they're managing their risk. So it's quite difficult to unwind complex derivative instruments, but it's pretty easy to sell the kiwi and get the hell out of Dodge.
And against the euro, could the kiwi be stronger against the euro?
Well, the kiwi's been, it's been back up over 57 against the euro, but it hasn't been sort of overwhelming. So, I think the kiwis, if an event was to occur in Europe, you'd have to imagine the kiwi will remain reasonably firm against the euro. But it's hard to say because our currency is still considered, a risk-on currency. It's still very, it's more illiquid compared to a lot of other currencies. So when those type of events occur, typically our currency drops quicker than a lot of those other, majorly traded currencies like the euro. Yeah.
So plenty to watch in Europe over the next couple of weeks. Across the Atlantic to America, where more signs of weak economic growth seem to be hitting the markets as well, the stock markets.
Yeah, so equity markets in the States have had another bad week. So last week we were talking about 12,000 as being a key level in the Dow Jones. So that was broken on Friday night. There was a small bounce on Monday, but then we saw another significant down day, down almost 2% yesterday. So the weaker data out of the States confirming that the first 6 months of this calendar year for the US has been very, very average. I think also, the impact of the higher oil prices. I mean, it's flowing through to all the economic data that we're seeing. So we haven't really seen any positive news out of the States either. But the US dollar is back in favour as a safe haven currency, relative to what's going on around the rest of the world.
And the key issue for American markets and for global markets is the impending end of quantitative easing 2, this round of bond buying from the US Federal Reserve, due to end on June the 30th. We're going to get maybe some hint next week from the Federal Open Market Committee, the rate-setting committee of the US Federal Reserve. Are people going to be watching that?
Yeah, they will be. The Federal Reserve are announcing their interest rates on Thursday morning, our time, next week. We're not expecting them to change interest rate policy. They've been quite clear that interest rates will continue to stay lower for an extended period. But again, the rhetoric around potential QE3 or what they're going to do as far as other sort of policy measures is going to be closely watched. I do think the market's underestimated the impact of the end of QE2. I think if you go back to when QE2 was first announced, you've seen this massive rally in commodity prices and equity markets. And that liquidity, or at least the impact of that liquidity in the short term and on sentiment, I think is being reflected in the markets, and you're seeing that clearly in the way commodity prices are behaving at the moment, and the bigger focus on the negative news, and equity markets as well. So
closer to home now, Australia, we've seen a little bit of economic data and some commentary from the Reserve Bank of Australia about future interest rate increases. But there seems to be some doubt creeping into the market about those interest rate increases. Yeah,
there is, because the Australia's run of economic data lately has been worse than expected. I mean, it hasn't been that bad, but it certainly hasn't been as mind-blowing as the market was expecting. But Glenn Stevens, the RBA governor, came out on the other day at a speech and basically indicated that interest rates are more likely to go up. He wasn't very clear about the timing. He said it's going to be a matter of watching the data. But their official cash rate is set at 4.75%. He made mention of the currency. He said, Australia, the Australian economy needs to adjust to a higher currency. So similar to Bollard, he looks at the currency and the way the Aussie dollar is performing against the US, it effectively all-time historical highs, and justifies it by the higher commodity prices. So he's sort of telling their economy that they need to live with the higher currency and look for other structural opportunities to take advantage of that.
So over the next week or two, we'll be watching particularly what's happening in Greece and in Europe, but also what's coming out of the US Federal Reserve and our central banks here. Dan Bell from HiFX with Never a Dull Moment, our weekly currencies report here on interest.co.nz.